Likewise, CMG Home Loans with your weekly mortgage update. And I hate to be Debbie Downer this week, but it was a pretty tough week this week for the real estate market with lower existing home sales and the mortgage market. Interest rates have gone up. They're over 7% now. And let's take a look at some of the reasons as to why that happened. So here we've got our weekly talking points that we can go through here on the week at hand here. So builder confidence, that actually went down. The National Association of Homeowners confidence dropped 6 points to 34. So you can see that the confidence is actually going down here, and that is not good news. Well, why is that? That's because of the tariffs, the building cost to build a home. They don't know where those things are going to be. So that put housing starts, that actually was subdued as well. So new permits issued fell 5%, annualized pace of month over month to an annualized pace of 1.4 million new homes. So this is not good news with the permits going down. The uncertainty again of the tariffs are driving these things. The credit rating, U.S. credit rating, Moody's, they downgraded the U.S. credit basically, and I'm going to go into that in just a hot second. In response to all of that, the yields, and I'm not quite sure it's just because of the downgrade of the bonds as to why yields went up, but I think it was a little bit has to do with the bill that was just passed this week as well, and kind of the increase of the debt for the government there as well. So the good news is that wholesale inflation, it dropped last week. The PPI went down, so we talked about that last week. So existing home sales, normally this time of the year, they are hot, but they've been dropping. And so you can see here with this is that the annualized pace is 4 million units. That's 2% below 2024, 5% below 2023, and 28% below 2022. So the inventory for the housing is up, and that's good and bad. So it's basically less pull through on the housing market at this point in time. A lot due to the interest rates, a lot due to kind of some of the uncertainty in the market. And it has not been great news, right? So the competition, it does normally pick up in the spring, but you can see that it's kind of in that downward trend there. We should see this pick up a little bit, but what we need is a little bit lower interest rates, and then we can get this market moving again. So let's go into the U.S. credit. So the credit, it's already been downgraded before 2023. I'm not quite sure why the bond market is reacting to this downgrade of the credit, because we've already been downgraded. We've already been here by some of the other agencies. And so Moody's move was just this week was to kind of say, hey, you know what, it's less attractive to hold the U.S. credit. Now, let's talk about it here. So I'm going to go down here. This is, if we look at this, there's AAA ratings, right? So these are the AAA rated companies or countries, and the U.S. was just downgraded here, all right? And so we went from a 800 credit score down to a 780 credit score. And so what does that mean? That means that you're going to pay a slightly higher rate for the U.S. bonds, and that's what the bond market has basically done, is that our credit has gone from an 800 score down to a 780 credit score, and because of that, we're going to charge you, the bond market is basically saying, we're going to charge you a little bit higher rate for that lower credit rating. And so that's what this is, and that's what's kind of driven the yields up on the 30-year bond, the 10-year bond, and the 2-year bond. All of the bonds have gone up, and it's just a function of what the expectation is for you as an investor to buy those bonds and what you want for that rate of return based on the credit that you are having. So to go a little bit deeper in this, it's like this. So it's a supply and demand issue. And as the debt of the U.S. government goes up, and even all the countries around the world, as the debt goes up in those countries, they're going to issue more bonds to be able to keep the government going. And so what the bond market is basically saying to even the politicians at this point in time is like, look, you're going to need to slow down the roll a little bit here. You've got to cut the spending even further in order for this to make sense and get that deficit down. So that's what we're trying to do. That's the kind of the mix here as far as why the bond market is basically saying, look, I want a higher yield for the return on my money. And so that's why the yields have gone up. Realtor confidence basically is it's gone up. I'm not quite sure, but it's gone up there a little bit. So a couple of things here. Let's go to, there's less competition, so less offers on properties. 2.4 offers on each property. That's down from 3.2 in 2024 in April of 2022. So that's going down. So the competition is going away. I think it's a good time to roll with a purchase right now because there are less offers and they're starting to drop. Prices are starting to come down. So interest rates right here, 30-year fixed rate loan, 7.07% on a 30-year fixed rate loan. So that's gone up over the last couple of weeks. And let me just show you the yield on the Treasury. So this is the pricing of the bond. So this is the prices you can see are going in this downward trend. We started to see a little bit of an upswing here, but you can see this is clearly a reduction in the prices, and the yield actually went over 4.6% on the 10-year Treasury. This is what really drives some of the mortgage rates at this point in time. But yeah, it's gone up. As of today, it's come back down a little bit. It's sitting right at 4.5%, kind of like that middle ground. You can see there's a resistance level right here that it's kind of hit, and this is the next support levels. So right down here at the 440. So we're kind of in that middle range of 4.5%. I think that's probably where we're going to end up before the long weekend here. And then I do think that over here, this is an interesting point. I'm going to point it out here. This is 3.919. That's the yield, right? Scott Bessent, Treasury Secretary, has basically made a comment over the last couple of weeks that that's where he wants to get the yield down to on the 10-year Treasury. So it'll be interesting to see over the next few months here how what he does strategically to get that yield all the way down. That would be a big move to get it down to 390. And that's where interest rates would be a lot better for the purchase market and getting buyers out there and moving with the real estate market. So if you want to see an article, there's an article here in the Wall Street Journal bond market basically talking about why the Washington move and so forth with the bill and how it relates to the bond market and yield. So if you want to take a look at that, you can. But just wanted to say I will be around this weekend. If you have any questions whatsoever, just feel free to reach out to me. I hope you have a great Memorial Day weekend, and we will see you next week.